Andrew, thank you so much for joining me. I wanted to talk to the world out there a little bit about life insurance. And so thank you for joining me. For me, life insurance is that one of those things I worry about. I sit up at night and worry about my clients. Sometimes as a loan officer, my team's the first professionals that they work with, us and real estate agents. And so oftentimes the first big thing you do is buy a house. And sometimes that comes with kids. And oftentimes people don't think about life insurance. So you don't want to think about death, right? You don't want to think about the fact that you're going to die. But you just bought this beautiful $350,000 house. And, part of taking care of your family is putting a tiny little bit of your monthly income into protection. Thank you for joining me. So tell me a little bit about you before we get started.
Yeah. So I'm married, got 4 children, ages 6, 4, 2, and 3 months. So we have them all piled together. And I grew up in the Forsyth County, North Georgia area. And then I moved out to Alabama in 2013 and went to a ministry Bible college out there. It was a 2-year program. Met my wife while we were out there. So I ended up getting a job with FedEx. And at the same time, also bumped into a friend of mine who did what I do now, financial services, help people with insurance, investments, saw debt and all that kind of stuff. And it sat down with my wife and I just educated us on it. And I thought it was just like, this is great. Nobody's ever showed me this stuff. I wish I knew this earlier. And I was only 22 at the time. Slowly grew my book of business, helping clients with what I do now.
Tell me what drew you to life insurance and planning.
Yeah. So from the finance side for me, number one, I wasn't something I had personally set in place. My wife and I were like, this makes so much sense. If I die, you need my income. If I die, I needed her income. We didn't even have kids at the time. It was just like, this is a no-brainer. And it was like so inexpensive comparison with what like even our car insurance and other things where it was like, this is absolutely like, the amount of value you get for the cost was just no-brainer for us. And then after doing that, then having kids was like, man, we've already got some great things in place. This was great. End up upping your coverage over time. And so what I found though, from that side, obviously I thought that was valuable, but really one of the 3 reasons I got into it was seeing just kind of the way the insurance market was. And also how I feel, looking at the demographics of just who gets help in the United States when it comes to finances is either really high net worth people or super low net worth charity, government assistance type of situation, which I'm thankful for both. But then there's this huge gap of people in the middle that their solution to get help is if somebody's going to make bank helping them typically. So, right. And so that's where I noticed that you're working with a whole lot of people that I call make-believe financial advisors that help you with some sort of insurance solution. And it's all in one thing. And they end up selling them an insurance policy rather than an actual financial plan, because the compensation on just doing an insurance policy for somebody is like 2 or 3 times more than what you do actually getting a little bit of insurance and putting some money away, emergency fund, if you that kind of thing, doing the right thing for somebody that somebody should do pays a whole lot less. And so when I saw that, number one, it was a worse outcome and the people got paid more, I was like, I want to make money, obviously, but it's like, these people are getting a worse outcome and I can see why the incentive is there. So, and then the company I'm working with now, they are just big on, that's what we teach all day, every day. Insurance should be a very small part of your overall financial plan. And we don't want to funnel your money into the insurance company. So when I sat down with just literally 4 or 5 people when I first started, and almost all of them owned this cash value, whole life, universal life type insurance. I had no idea how it worked. That right kind of what lit me up of just like, no, if you had read this before you bought it, most people wouldn't have bought it. And what I found is it's because people don't read insurance contracts. That's not
right. Right. And there's different, so we can talk about the difference between whole life and short-term life. But I think you and I would both agree that the average human everyone needs term insurance. And there may be financial situations, you and I may disagree about this, but there may be financial situations where whole life is the answer for certain net worth people when they've already exhausted their 401ks and Roths and all the things. That it's an interesting financial instrument for the people making more than $500,000 a year or whatever. But for the normal humans in the world, the most critical thing is that you have some life insurance. Like, I think it's amazing to me. I used to manage 28 people. So like I brought in an attorney and made everybody sit down and write a basic will. And it was amazing to me how many people who had children didn't have a will. And I feel like term insurance is just like that. You said the other day that you could get a 35-year policy.
Yeah, we have term lengths up to 35 years.
When I was starting out, we got a 20-year policy. So the idea being that when you're young and you're healthy, you can get super affordable insurance. And then that monthly payment you pay for the insurance is fixed for the next 20, 25, 30 years. And the idea is that if you're doing that along with savings, then your investment should grow. And once you get your kids through college, you shouldn't need so much of life insurance at that point, because at that point, you don't have as much responsibilities and you've had a chance to build your asset base. It's when you're 30 and you have 4 kids and you pass away that there's a serious problem. So really, for me, the people I want to shake are the young people. If you've got a 27-year-old who's a male, who's in really good health, low weight, wild guess at what $1 million of insurance costs for that person, or $500,000, whatever's appropriate.
It could be anywhere from $40 a month up to $100 a month.
So let's say it's $100 a month. If you pay $100 a month and you get $750 or $1 million in coverage, that is the security blanket for your family that you have to find a way to afford.
Yes.
So Andrew's the person that you're going to talk to. You're going to come sit down and talk about the different options. So one question people ask is, should you cover a spouse that's a stay-at-home spouse? Should they have insurance?
Yeah. The way I phrase the question through my sales process generally is we have like a calculator up, and we're trying to figure out what are the needs for each person, right? How much, and what typically I'm looking to, let's say we're insuring the husband or whoever the main breadwinner is, right? We're talking to that person first. And then I talk to their spouse and I say, how much of their income are you going to need or want, God forbid something happened to them? How much of that is it? Now, is it all of it, more of it, less of it, And so they get to, then most people are like, at least all of it. I mean, if they were to die, like I still need all that income,
Right.
Then we go vice versa. And typically whoever the main breadwinner is, especially if it's a man, it's like, they're like, oh, my wife would be fine. But then I'm like, well, are they watching kids for you right now? And they go, yes. Okay. So that's an expense now, because I think the average, what they tell, it's over $100,000 a year is what you'd have to pay somebody to do what mothering does throughout, it's like an expensive nanny type position that you'd have to hire. And so even if there was no declared taxable income on that part, there is a monetary value to the services being provided in that scenario. And then the other thing I always show people is, I mean, even on kids and things, it's like, if you lost your spouse or lost a child, the last thing I want to do is go to work next week.
Right. So what kind of, if you're the kind of person who has a big travel job, you're a big professional, you're out with clients at night, you don't have to worry about any of that because your spouse has your kids. How does the kind of job that you'll be able to do, the kind of income potential that you're going to have if you're on your own, you're going to want to be much more involved, because it's just going to be required if you have kids. So yes, so both of us would agree that a stay-at-home spouse should be covered. Also, you want to cover them. You want everybody to get covered when they're younger, before they have health issues. Because if somebody has a health problem at 35, it's much more difficult to get insurance put in place at that point. Once you've got a health issue.
Yeah. And life insurance is never one of those things you can go back and get. You can't go back in time and get it. And it's always based on your current existing health. And so you bring up the right point, and I think this is sort of the reverse thinking that the average like American psyche is thinking with, even like stuff with the will, like, okay, I need a will when I'm old, preparing to kind of pass my assets around, when really that's like the worst type of financial tool you could use to pass your assets with. But that's where people and then people think life insurance is the same thing. Okay, well, I could die. I guess I should make sure my family has something in case, and it's really both of those situations, the exact opposite. And we teach, maybe I've shared that graphic before that you've seen, but it's these two arrows that crisscross. Essentially, it says, we call it the theory of decreasing responsibility, where when you're really young and healthy, the loss of your income, that's when it's the most devastating because your savings is down here, right?
Right.
But it ultimately flip-flops if you play the game right and you have a plan for both directions. And so now it's if you had a lot of money and you wanted to keep insurance when you're 50, 60, 70 years old is expensive. But if you had a lot of money, you could pay it if you wanted. Like if it's just
Right.
something you felt better having, you could.
Right.
But ideally, you don't even need it because you have the pile of money. So that's like it's the flip-flop reverse. And so people will think, oh, I need it here. Well, no, I'd much rather have a pile of money down here than just an insurance policy. Whereas the reverse is everybody would love to have a pile of money when they're 25 and 30 years old, but
Right.
it just takes time, so.
Right. Right. And so that's why term is such a great instrument, is that you get so much coverage for such a small amount of money, which is the critical component from the time you're 25-ish until you're in your 40s. And once you're making that $500,000 a year, then you and Andrew can argue about whether or not to do a whole life policy. But until you're making tons of money, we would agree that we would not recommend a permanent life insurance policy. Get that short-term policy, and then take that extra money and put it into investments. I think we would both recommend, max out your 401k if you're getting matched every time. I don't care what the situation is. Every time you get the opportunity, you're going to invest until you get the full match from your employer. So I have a friend who didn't have children until he was in his 40s. Well, he was like, why do I need life insurance? I don't need life insurance. I don't have kids. And, my wife makes plenty of money. Why do I need life insurance? Well, reality is then when he went to go get life insurance in his 40s, it was not easy. It was a whole, it was doable. Mm-hmm. You can still, even if people are older or they have like health problems, you can get them insurance. Yeah. But tell me a little bit about like what you have to go through to get an insurance policy.
Yeah. So depending on the carrier, we have two different products that we do. One that requires no formal medical underwriting, where somebody's going to come and that usually we send like a paramedical type nurse type person to your house or wherever you want them to meet you at, or you could go to their office and they take blood work, urine sample, and then they take current height, weight, and vitals, right? They want to check all that. And then they're looking for details all the way down to like your cholesterol, like all the way, all the details of your health to know how comfortable are we with your current risk, even if it was something you were unaware of, right? So we have an option that does that. Obviously, the more the insurance company knows about your health, the better the pricing you're more likely to get because they have more confidence in their risk assessment. Whereas if they don't have as much information, they're going to charge more, but it's no hassle, right? You just sign some paperwork. They do a quick medical records check just on your background and stuff. That's another thing that can cause an issue, though, is that, one of the cases that I've worked with is people that are diabetic, or they've been diagnosed as pre-diabetic or different things like that. As soon as something like that's on your medical record, it becomes a big hassle in getting coverage. Or for someone who's a diabetic, type 1 diabetic anyways, if they have a time where they go to their doctor and their A1C and all that stuff is off, and it's like because they were partying and they didn't watch their blood sugar, well, that goes on their record. And now would be regularly, let's say they're really on top of their numbers. So that's even something too, where you could have a random kind of health spike, go to the doctor, something gets put on your record that you had high blood pressure randomly because you were stressed at work. And now that's going to be really hard from a medical record standpoint to get coverage potentially, or it may prevent you from getting a better rate simply just because it was on your record.
The earlier you do it, the less drama that you have in your life, the easier and the less expensive that insurance will cost you over time. But if you wait till you're 40, still go get it, because you can get it. It's just going to be more expensive.
More expensive, and the chance that you have some other, even if it's a minor health challenge, that really maybe it doesn't even totally affect your mortality risk, but from a quality of health standpoint, they look at that like hey, you have this chronic issue. I've even had issues where people had trouble getting coverage because they were prescribed something and they never took it.
Yeah.
And so it's like,
it's messy. It's messy. So do it when you're 25 and you don't have all the messiness. Exactly. But even so, there are policies out there, even if you have some risks. So everybody get it, even if it's more expensive. We just want you to do it when you're younger so that you get the best possible deal. And I think you told me that there is a policy for seniors to cover final expenses.
Yes. So we do have a program for a type of final expense, or even somebody who's pretty bad health and they've been declined elsewhere just because of their health in general and their age. And so we have a program that essentially decently priced, but if you were to die within the first year, you'd get all the money back that you paid in. So you at least get your money back. And then every year you get your money back plus a percentage of whatever you were buying. So maybe I think it's up to $30,000 that we do. But basically there's no formal medical underwriting. It's like as long as you don't have cancer with a 6-month terminal diagnosis, we'll cover you, kind of a thing.
Right.
That's pretty much it. And so if you had high blood pressure, if you're overweight, if you had these other diagnosed things like that, you could get coverage as a worst case scenario type of option. And then it's going to be more expensive than obviously had you got it in a healthy situation or younger, but it gives somebody that they've got no savings, no liquid assets at all to cover final expense. Okay, this maybe is not a bad.
That might be a way to feel like you're leaving your family in a little bit of a more comfortable situation when you don't have enough assets sitting around for final expenses. And the hard one is long-term care insurance, because nobody gets it until you're older in life, and it's so expensive. You probably don't want to get it until you're older, but it's super expensive. Do you have any thoughts about long-term care?
Long-term care insurance in general is just going to be really expensive right now, just because of part of it is insurance companies that were providing that got eaten alive with baby boomers. So many of them retiring, cashing in on pretty decently priced and long-term care coverage. And so as far as, and I don't know if this is the direction you wanted to go with this question, but there are certain types of life insurance policies that provide some long-term care. I am not convinced mathematically that they pay anything equivalent to what a traditional long-term care policy would, mostly because the benefit that you're receiving from they're going to pay so many expenses per month for your long-term care is based on the performance and the dollar amount of the cash value in your policy. And so if that has been underperforming and there's been high fees, then yes, you've got it, which is nice. But I think, we could argue some alternatives like an HSA or something might perform a similar function that could be used. It's not as exciting necessarily because you don't get a 500-page document to explain it, but I'm not quite. That's kind of a newer thing I'm running into. My typical market is, like you said, I'm working with people who are younger, 45 and younger and I think that's a good place to help people because it's really when it's going to be most affordable. The situation where I'm running into that type of thing, it's kind of we should have had other money saved, but we don't. So this is kind of the Band-Aid solution.
Right. So that's the thing is when you get into your 50s, 60s, 70s, at that point, ideally you have plenty of money you've saved over time that can pay for whatever care situations you run into. But that's not always the case. And so long-term care is really a financial planning conversation. It's really a conversation to be had in your late 40s and 50s. It's most of us are not going to deal with long-term care. We're going to get our damn kids out of college. And at that point, who's got money? I don't know. I'm enjoying getting the last one's going to graduate here any minute. And I'm going to be done. That is a place where a high net worth person could, if they did have a whole life policy, it may or may not make sense to have a long-term care rider on a whole life policy. But ideally, you don't have to have that. Ideally, you have lots of cash and you can pay for whatever the situation is when it comes to you. But there are long-term care term policies that some people get. So anyway, that's just really a financial planning question.
And it definitely comes down to the dollars and cents and what is the real value you're getting here? And that's where even when you talk about the high net worth clients with some type of permanent insurance, it's always this is an expensive option. This is not your go-to cheap option. Does it actually, is there a net positive? And if there is, then I'm all for it. So that's where it's Would it be better to just put that $4,000 or whatever outrageous number it is into something else that would grow? There's stuff that emotion comes into it too. Somebody may legitimately, I'm just going to fork out the extra money just to do this 10-year paid up whole life policy, just so that I stop paying and it's just there and I've got it. I'm I could argue the math all day on that, but if the client feels happy with that, and that's just going to make their conscious, I'm okay, it's an expensive decision.
Right. So these are all things to talk to your financial planner about. I have a client who put $50,000 into an account, and that became her long-term care bucket. And she could add an insurance component to it, so it's guaranteed to cover long-term care, or she could just let the $50,000 grow over 10 years, and she probably gets better numbers if she doesn't have the insurance, as long as she lives a while. So these are all the conversations for you and your financial planner. Andrew, anything else you want to throw out there before we cut off?
The one thing you had mentioned before is people getting insurance when they're young and maybe they don't have kids, they don't have a spouse. Why would I want to get it? Well, yes, we mentioned price. One of the things that we offer with our policies is a increasing benefit rider option. So obviously, if you were 25 years old, you don't need $1 million of coverage. Could you get it? Yes, because it's cheaper, but it seems a little absurd to get that. So maybe you get something basic, and there's some benefits, like there's a terminal illness rider built in on the policy. So if you kind of like a spillover for your health insurance, if it wasn't going to cover some sort of, treatment. So there's that. But it's still, we're talking $30, $40 a month, maybe cheaper for like $150,000, $250,000 of coverage. And we offer a thing where without ever having to do another medical check, you could up your coverage 10% over 10 years. So double what you've got over 10 years. Now, if you're in perfect health, that during that 10 years, it's going to be cheaper to just reapply for new coverage and get $1 million at that time. But I have a client who we did that 4 or 5 years ago now. They received some type of, I'm not exactly sure on the cancer diagnosis they received. He's only in his 30s. And he couldn't, even if he wanted to apply for more coverage now, the moment you find that out, everybody would go buy a $5 million policy, right? But so he can't, but he's still got 6 more years of a 10% increase on his policy, even though he's got this diagnosis, all because he got it when he was young, didn't have any kids at the time, but it'll just keep increasing. So for somebody who's young, it would be great to get $1 million, but maybe it's not affordable. But then you're going to plan on having.
But at least if you get started, then you have it. Okay, so that's just more to the planning concept. We need to start having these conversations young, and you're going to call Andrew, and he's going to help you figure out what's right for you. And but everybody get life insurance, or I'm going to bug you until you do. Thanks, everybody.